Decentralized exchanges are what they sound like. They're cryptocurrency exchanges that exist on the blockchain and allow users to participate either as buyers and sellers. That is, you can go onto a decentralized exchange and you can trade cryptocurrencies, or you can participate as a liquidity provider. And what that means is you're effectively taking the other sides of those trades, and you can profit by being effectively the enabler to enable other users to trade on the exchange. And the largest decentralized exchange is Uniswap, and I've spent the last few days trying to figure out how the whole thing works. Essentially, they use something called a liquidity pool, and so my objective here is, having actually finally, I think, understood all this, to try and go through it and explain what is a liquidity pool, what does it actually mean if you say to provide liquidity, and what's the difference between the Uniswap V2 protocol and their new V3 concentrated liquidity protocol, and how does that work? So what we're going to look at is, firstly, what's a liquidity pool? Secondly, what does providing liquidity mean? It's looking at all the materials I saw online, people kept throwing this around without exactly saying what that means. And personally, I found that confusing. Anyway, so I'm going to go through that. Thirdly, how can you make money providing liquidity? Then, of course, how can you lose money providing liquidity? And finally, how can you make more money by providing liquidity for a specific range using the new Uniswap V3 protocol, and exactly what that, how that works and what that V3 protocol means. I would say, before going any further, that I'm most certainly not advising anyone to invest in any of these things. Both as a trader and as a liquidity provider, you can certainly lose money, and the objective here is just to more try and understand the mechanics of how this works, and certainly not to provide any investment advice. That being said, let's start. What is a liquidity pool? Well, a liquidity pool, if you're setting up a liquidity pool, you put up equal values. It started with equal values of two cryptos, and here and throughout this whole analysis, I'm going to assume that you who are watching the video, own the entire pool, as opposed to just owning a share. In reality, you don't own a share of a pool, but it's kind of easier to understand if you're just looking at it from the perspective of one investor. So you own the whole pool. Secondly, I'm going to assume it's a DAI ETH pool. ETH is the Ethereum cryptocurrency, and DAI is a stable coin which is pegged to always have the value of $1. And we would assume in this example that it keeps its peg, and so it always stays at $1. And we'll assume, just again for this example, that the initial price of ETH is $100. That is, obviously it's way away from that now, but the numbers work for the example. That is, so the price of Ethereum is 100 DAI. So the price of ETH is 100 DAI, and you fund the pool. We're also assuming that this pool is funded with an initial contribution of 1,000 ETH and 100,000 DAI, right? And the initial value of the pool, as we said, you need to put in the same value of both cryptocurrencies. So you've got 1,000 ETH, each worth $100, worth $100,000. You've got 100,000 DAI, also worth $100,000. So initially, the value of the pool is $200,000, 100,000 which is in ETH, and 100,000 which is in DAI. We're also going to name a quantity called K, which, I won't go into a lot of detail, but it's fundamental to the mathematics of the pool, and it's essentially it's the number of ETH multiplied by the number of DAI in the pool, and this starts at 100 million, 1,000 times 100,000, and the mechanics of the pool assure that the quantity of ETH times the quantity of DAI, that number K, always stays that 100 million number. Okay, so a liquidity pool, what is it? It's a pool, two cryptos of equal value start the pool. So what does providing liquidity mean? a lot of the explanations I saw online talked about providing liquidity, and you can, make money by providing liquidity in a narrow range, and blah blah blah. And I had actually kind of a bit of trouble trying to figure out what people were talking about. So, but ultimately, what providing liquidity means is it just means that your pool, and we're assuming, as I said, that you own the whole pool, takes the other side of any trade if someone wants to trade, right? So you've put up 1,000 ETH and 100,000 DAI. If someone wants to sell you ETH for DAI, you buy that ETH and give them DAI. If someone wants to buy ETH for DAI, you sell them ETH and they give you their DAI in exchange. And once you're in the pool, you don't choose whether to do this. You kind of make a deal by putting your funds in the pool that the pool will automatically fill their trades for them. That's the contract that you're making. And the price at which you trade is set by the automatic trading rules of the pool. Okay, so someone can always come to the pool. It will trade. You will effectively trade with the pool. You don't have a choice whether to do this, and the price is set automatically. So the pool has these price setting rules, and the automatic trading rules set the ETH DAI price according to the amount of ETH you hold in the pool. As the amount of ETH you hold goes down, as you hold less and less ETH in the pool, the price is automatically raised. So as you start with 1,000 ETH in the pool, as people buy up your ETH, the automatic trading rule automatically raises the price it charges for ETH, and as the amount of ETH goes up, as people sell you more and more ETH, the pool automatically lowers the price that it's prepared to pay for them. And this is where K comes back in. The price is set, so the quantity of DAI times the quantity of ETH is always equal to its initial value. This means that as the quantity of ETH in your pool changes, the price will change in a fixed relationship. The more ETH people give you, the lower the price you'll pay for it, and the more ETH people will buy from you, the higher the price the pool is going to charge. And I've got this relationship on a chart here, and what you can see is the pool's starting position with 1,000 ETH and 100,000 DAI, and initial price of ETH of the DAI at 100. Price of 100 DAI per ETH. And you can see, if you look on the left-hand side, as you're holding, your ETH position goes down from 1,000, where there's a little dotted line, to 400. The price goes up to something from its initial price of 100, something over 600. And as people selling you more and more ETH, the price quoted by the pool is going to be lower. It's going to be lower and lower. And at 2,000, it's you see it's 120 or something like that. As an example, at extreme levels, which the chart goes effectively up to infinity. If the pool if people buy out all your ETH and you were down to your last 10 ETH, then the mathematics tells it's automatic. As I say, it's an automatic price setting mechanism that you'd sell ETH at a million DAI or $1 million per ETH. On the other hand, if the pool was down to 100 DAI, and you started with 100,000, if people had taken all but your last 100 DAI, then the price of ETH would be very, very low, and it would be 100th of a cent per ETH effectively. So all this says is that as your ETH position changes, the amount that the pool charges for ETH, it goes up and down. The more ETH you have, the lower the price it charges. The less ETH you have, the higher the price. Okay, right. So one thing that confused me to start with is okay, so let's say the pool is saying that it's charging. So the automatic trading rules is setting a price of 500. Right? People have taken away a lot of your ETH, so you're setting for whatever reason, and so the pool is charging a really high price. And the market price is only 100. Who says you're going to be able to get your price? That is the automatic traded price. Well, you will. Unfortunately, you will get the automatic price. So let's say that the market price is 100, but the automatic trading rules set the price at 500. Remember, the pool is ready to buy or sell at this automatic trading rules price. So in this case, what's going to happen is you're quoting a price of 500, the price in the market is 100, so guess what? The market is going to come and sell you a whole ton of overpriced ETH at 500 when the market price is 100. However, as you buy more ETH, the pool is going to lower its price, and this will keep going down until that automatic price is equal to the market. Right? Similarly, if you start with, for whatever reason, if someone is giving you a ton of ETH so that your ETH is really cheap, it's below the market price, then guess what? You're going to still going to get that low price. How? People are going to buy your discounted ETH, right? And they're going to make money on buying your discounted ETH. And as they take away your ETH and replace them with DAI, the automatic trade price will rise. And it's going to keep happening until the automatic price is equal to the market, right? Because at that point, there's no further incentive for people to come in and either buy or sell. So the pool will always find transactions at its price. So although the price is set automatically and is not per se equal to the market, we'll always find transactions there, because if it's different from the market price, people are going to come in and take advantage of it being different from the market price, but they will always do so in a way which unfortunately will be unfavorable to the pool. This mechanism ensures, because of this arbitrage is going on, that the pool price is always going to be close to the market. If it's below, it's going to be brought up to the market. If it's above, it's going to come down to the market. Okay, so let's look a little bit further. So what does this do? If you have this structure, what we've said is, if you look at this graph, graph turns things on its side, and it says, like, as the ETH DAI price changes, which is along the bottom axis, you can see it goes up from 20 to 200, and the blue line shows more and more holdings of ETH as the price goes down, and the orange line shows less and less holdings as the price of less and less DAI as the price goes down, and more you're going to hold more and more DAI as the price goes up. Okay? And this is the point about this that's really interesting, though, is this is deterministic. What I mean by that is, if you know the price of ETH that the pool is charging, you know exactly how many ETH and how many DAI you have in the pool, right? And this is really important. And so I want to show one more example. And I'd ask you to be patient with this, simply because this is going to be important when we consider the difference between Uniswap V2 and V3, where these amounts, I'm going to come back to this example and look at these amounts again. But so here we have the pool. If you look at that yellow box, it says we have a pool, and we're starting with a position of 1,000 ETH and 100,000 DAI, with the ETH DAI price being 100. If you remember, that means both sides are each worth $100,000, and that's the starting price of the pool. Now, remember, we're saying that people are buying and selling from you on this pool. But what we know is that if there's a price rise, let's say the price rises to 125, right? The price, that is the price quoted by the pool, rises to 125. For that to be the case, we know that exactly how many ETH you have and how many DAI you have. If the price rises to 125, you will have, don't go through the maths here, but you can look at the math and figure this out. But it turns out you will have exactly 894.43 ETH and 111,803 DAI, right? It doesn't matter how you get there. It doesn't matter whether the price goes all the way up and then goes all the way down to 125. If you get to 125 price, you will have exactly that number of ETH and that number of DAI. Similarly, if the price falls, let's say the price falls to 80, you'd end up with, the price has gone down, so the pool's going to be buying ETH. And if you know that if the price is 80, if the pool is quoting a price of 80, that means it has exactly 1,118 ETH and 89,443 DAI. No ifs, ands, or buts. It doesn't matter if the price has gone all the way down to 20 and come back, or gone all the way up to 200 and come back. If the price is at 80, that's how many ETH and DAI you'll have in the pool. And as I say, this is really important when we look at V3, so bear with me, okay? But now we know what this is. So essentially, you know what a liquidity pool is. A liquidity pool is you put in 1,000 ETH and 100,000 DAI in this case, and then you're letting people trade against it at prices which are automatically specified. And so the next question is, how do you make money by providing liquidity? This is called providing liquidity. Well, that's simple. You get a fee. You get a fee which varies according to the assets in the pool for every trade. So as an example, let's assume that the initial value of the pool, as we looked at above, was 200 grand, 200,000, and the fee is 0.3%. And let's say that over the course of a year, there are 2.5 million notional value of trades. You would earn $7,500, which is 2.5 million times 0.03. And if you look at that as an annualized return on investment of the pool, that's 3.75%. Yeah, maybe not that exciting. Okay, but just in this example, I'm not saying this is in any way realistic. It's just to go through the numbers. This particular pool with that much trading, you own 0.3%, you get 3.75% return. So that's how you make money providing liquidity. You earn fees. Okay, so how do you lose money? Okay, that's also important. Well, guess what? If you enter in this pool, you're long ETH, right? Remember, you start with 1,000 ETH, and which can go up and down in value, and you start with 100,000 DAI, and the 100,000 DAI should keep their value, should stay the same. But as ETH goes down, so if ETH goes down, you're going to lose money, right? And as ETH goes down, actually, if you think about it, as ETH goes down, as the price goes down, you're buying more and more of them. So you're losing more and more money. And as the price goes up, you're selling ETH. So, you're kind of taking you're buying more ETH as the price goes down, and you're selling when the price goes up. Okay, then if you look online, you'll see lots of stuff about this impermanent loss thing, right? Now, this is really important, but I don't want to completely go into it here because it's more complicated, and this is just about the mechanics of what I want to talk about here is the mechanics of how the pool works. But it's really important to note that 0.3% you're getting is not a free lunch, right? That the fees that you're getting, right? Forget for a moment that you have Ethereum risk. There's something else going on here which you need to be aware of, and which is that, consider this, right? What this pool is doing for you is if the ETH price falls, it's buying, right? Automatically, it buys more ETH. If the ETH price rises, it's selling, okay? So that sounds like a pretty good strategy, right? That sounds great because if you think about it, you're buying low, you're buying ETH at a low price and you're selling it at a high price. You're buying at a low price and you're selling it at a high price, right? Now, if you did that with your own money, forget using the pool. Just let's say you bought low and sold high, right? Now, obviously you could lose money. How would you lose money? If the price goes to hell, then you're buying more and more low and you lose more and more money. But if you're lucky enough, price starts at 100 and you do a few rounds of buying low, selling high, buying low, selling high, and it comes back to 100. If you do it for yourself, you will have made money. You'll have made a profit because you'll have been buying low, selling high. Right? If on the other hand, you're doing this through a liquidity pool, we know that if the price returns to 100, regardless of where it's been, you're going to end up right back where you started. That is, you're going to end up with, guess what, 1,000 ETH and 100,000 DAI. So you won't have made money. So one way to think about it is you really need that fee because in a sense, you're being badly treated by the pool. The pool is not really giving you, in a sense, it's not giving you a fair shake because you've been buying low and selling high. And if the price comes back to where it started, you should have made a profit, right? But actually, you don't. And so that 0.3% is not a free lunch. It's a compensation for the fact that you're effectively taking that risk of buying low and selling high, but not making money if you end up back where you started. And that's a very sort of basic explanation. And I should probably go into that more, but that's for some other time. But the important point that I'm making is that the fee that you get for providing liquidity is not a free lunch. Right? It's actually a compensation. And the question is, so that means that this is something you should only do if you feel that you're getting sufficiently compensated for what you could otherwise be doing. And that's that all relates to the impermanent loss thing. But as I say, I don't want to go into detail on that here. So, okay, let's talk about V3. So the question here is, how do you make more money by specifying what's called a liquidity range in the Uniswap V3 protocol? Well, actually, you don't make more money. You just need to invest less to earn the same amount of fees. It also, by the way, it has a second advantage that you take less market risk. So let's see how that works. Okay, so let's look at this example again, and that's why I said please bear with me on the previous example that we looked at. So if you look, the yellow starting point says that we started the pool with 1,000 ETH and 100,000 DAI and a price of ETH DAI at 100. But we said because of the way that the pool works, we know if the price falls to 80, exactly how many ETH and DAI we'll have. And if the price rises to 125, we know exactly how many ETH and DAI we'll have, right? So if you set up a regular liquidity pool, you're saying, I'll take this other side of any trade, right? So, regardless of what the price is. So in theory, someone might want all of your 1,000 ETH, right? They might give you loads and loads of DAI and take all your 1,000 ETH. So if you're going to participate in a full range liquidity pool, you need to put in that 1,000 ETH and 100,000 DAI. On the other hand, you could set up a different liquidity pool, a range specified liquidity pool, as you can in the V3 protocol. We say, okay, I will do any trade where the price is between 80 and 120. Right? I will either buy or sell as you like between 80 and 120. If the price goes above 120, hey, go somewhere else. I'm not going to trade with you. If the price goes below 80, go somewhere else. I'm not going to trade with you. Right? And so you can set up a pool doing that. Actually, you'd be with a whole bunch of other people. They'd all be setting different price ranges, so there'd be the ability to trade throughout the range. But let's go back to the basic idea that it's you setting up the pool and it's just you and this, and you're responding to the demands of investors. If you think about what that means, it means that you know that if the price goes up to 125, right, you can see that what it says is you'll end up with, you started with 1,000 ETH as the price goes up. ETH has been sold, and you end up with 894.43 ETH. That means you'll have lost 105.57, right, which is 1,000 minus the final amount of 894.43 of your initial 1,000 ETH position. So you've lost 105.57. On the other hand, if the price falls to 80, right, you start with 100,000 DAI, you end up with 89.443. So you've lost, right? You've gained ETH, but you've lost 10,557 DAI. Okay? So what that means is that as long as you put up, the most you can lose is 105.57 ETH, and the most you can lose is 10557 DAI. Whereas if you're doing the whole range, the most you could lose would be 1,000 ETH or 100,000 DAI. So, but because of that, you can create a pool where you say, I will only take trades between 80 and 125, and all you need to put up is the maximum that you will lose. Because if you put that up, you're going to be available to take the other side of any trade. So instead of putting up 1,000 ETH and 100,000 DAI, you only have to put up 105.57 ETH and 10,557 DAI, right? And that means that you start a limited pool range where you're only putting up that amount, which the total investment in the pool is only, if the starting price of ETH DAI is 100, is instead of being $200,000, it's $21,114, right? And that's because you're saying, I will only take the other side, again, using the same automatic trading rules, I'll only take the other side of trades that fall within that range, right? So what does that mean for your returns? Well, if we assume that over the course of the year, all of the trading that takes place in that range, 80 to between 125, then as the owner of that range specified pool, you'll still earn exactly the same fees. Obviously, if it trades outside that range, you won't. But just for this example, let's assume that it does. In the previous example, the pool owner had put in 200,000, and so that was an annual return of 3.75%. On the other hand, the pool owner, in this case, restricts liquidity to between 80 and 125. As we said, they only have to put up 21,114, and that means they have an annual return of 35.5%, right? Because they're still getting 7,500, but this time they only put up 21,114. So it means that they're getting a much, higher return, right? The other advantage to the pool owner is, if you remember, in the first example, the owner of the pool had to put up 1,000 ETH, which is worth $100,000, right? In this case, because they're restricting the liquidity range, they only have to put out 105.57 or 10,557, and therefore they're subjected to a lot less price risk. So the advantage of these type of pools is you can generate much higher fee returns per investment, right? And at the same time, you can take less price risk on the other underlying cryptos in the pool. Okay, last and final point. As I said, this is not a free lunch, right? If we said before that effectively the pool is treating you badly and there's a cost for the fact that you're not being rewarded for buying low and selling high, and you should be. If that cost is greater than the fee that you're getting, then actually investing in the pool will, in the long term, be a losing proposition. If you leverage it, which is effectively what you're doing by creating a range, as in this example, then it doesn't help that. If it's not a worthwhile thing to do over the entire range, it's not going to make you money over if you restrict the range as well. So that's just that final point. So hopefully that explained a little bit how liquidity pools work, how the difference between full range pools, which is the V2 Uniswap protocol, and the V3 protocol, which works on restricted range. So if you've made it this far, thanks very much for watching. If this has been helpful, or I guess even if not, please leave a comment below. I'm also including a link to the PowerPoint slides in case anyone wants to download them, as well as my email address in the info accompanying this video. So please feel free to contact me directly if you have any questions.